brokerage earnings or earnings for IIFL, they have now hit the turf, they've bottomed out?
See, if you look at our last 3-4 quarters results, then the profits have been on the rise, primarily driven by NBFC. So our June quarter was significantly better than March, March was significantly better than December, and December was better than September. So I think we have had 4 quarters of, or 3 or 4 quarters of consistent growth.
So what are the pain points for your business?
At this point in time?
At this point in time?
I think the broking business continues to remain volatile. And the sentiment might have improved from the late September, or which the impact should be seen in this quarter if the things continue. So that business is very volatile, but fortunately for us, that business has become relatively smaller as a overall, the overall business model. So at this point in time, the interest rates remain high. The NBFC business, the growth business, is basically not viewed favorably, which is a bit of a debatable issue, because everybody is convinced, even RBI, that NBFCs have a role to play. They have the last mile connectivity. But what is happening, the funding sources are all tightened, so that NBFCs can't raise ECB. Banks have been informally told that go slow and reduce your exposure to NBFC. In India, corporate bond market, unlike USA, is not developed, so it's not easy to raise money by way of bond. So where do you raise money from? And NBFCs can't raise deposits also. I mean, no new deposit taking NBFC has been allowed by RBI. So what has happened in Indian market, the way things have evolved, it's pretty primitive in terms of the bond market. Normally what happens, developed market, you'll see that there's a lowest level of risk government securities market, and there's a municipal bond, there's a corporate bond, and the junk bond. So there are various 3 or 4 tiers. And that has been one reason why USA has been able to absorb this entire shock very well. But India, what happens that there is no such market actually. And so the government and RBI have to take steps to make sure that the bond market develops. And till then, they have to realize that NBFCs are doing a meaningful, they are playing an important role in the economy. And therefore, there's no point in squeezing or no point in tightening the sources of funding to the sector.
But broadly, would you agree with my assessment that retail investors are out? If I look at the SEBI data, 8 out of 10 mutual funds in the month of September, they have got outflows. And more than anything else, it is the overall pessimism which will drive markets, because as of now, Indian retail investors are selling, and there will be one day when they will be forced to come back.
I think it's a very valid point. There has been a lot of debate on mutual funds, first entry load, and then the expense ratio was increased, and now there's a cap or this thing on a brokerage that they can pay. In principle, I believe that regulators should not get into pricing, because it's almost like running the business. At the end of the day, are you there to ensure the fair play, or are you going to decide that this price is good, this price is bad? Compare with the manufacturing sector. I mean, you may have potato chips, there 20 paisa potato is sold in 20 rupees, but it's not that the regulator will come and say that this is the price. So I think the 12 basis point cap that has come, that will actually weaken the research industry, which has played such an important role to make sure that the mutual funds get good quality research, and therefore they make good quality investment, which actually benefits retail investors.
You're talking like a promoter, but a cut in brokerage industry will actually benefit the retail investor only.
No. See, what is happening is that we have to look at things holistically, and something may be very good for the consumer, but who's going to sell it? That's a question that we need to. So many times, from the regulators' viewpoint is that we should protect and benefit customers. Brilliant, I agree with that. There are no questions about it. For most of the products and services, I'm a consumer, say whether it's a banking or any other product. But one should not forget that unless industry is healthy, who's going to service the customer? And therefore, I think mutual fund industry, the retail investment in equities should go through mutual fund. Because typically somebody wants to invest say 1 lakh or even 5 lakh rupees. I don't think that direct equity is a safer route, or is easier for you to build a portfolio for 5 lakh or even 10 lakh, which is fairly balanced, healthy, and you can monitor it and do something meaningful to it. So I would, although we are a broker and one of the largest retail brokers, and it is not in our interest to say that retail people should not come to direct equities because it hurts our brokerage. But if I have to be honest and candid, then small investors are better off coming through mutual fund and not through direct equity investment. And that is what the note which government and policymakers should take, that we need to mobilize more retail savings into mutual funds. And how they do it is, of course, there are multiple ways to do it.
Nirmal Jain has always maintained that his biggest bet is India Infoline stock. But if you have to construct a portfolio for your 3 children, what would you like to buy in that portfolio?
No, as we just discussed the portfolio, FMCG, pharma, cement, these are the stocks that I'll put. But if I have to construct portfolio for my children, then most of it I'll put it in fixed income securities and government securities. And
You'll not buy stocks?
I'll buy a stock, but maybe say 25% of it I'll put
Which
in
is
stock.
the 25%? How will you invest that 25%?
That's what I said, that FMCG pharma will account for 50% of it, and the remaining will be a mix of cement, banks, and some other mid-cap and large-cap stock that I discussed.
Give me a stock which you've been holding on from last 10 years, and you will not sell that stock regardless of expensive valuations or okay valuations for next 10 years.
No, I think the one stock is IIFL, which I not sold a single share, and I only bought whenever I had little spare money. So, when we are into this business, I'm not into active portfolio management. So in fact, we have our own wealth management, and there's a relationship manager, advisor. They take care of my portfolio, and we periodically discuss. So other than IIFL, I don't remember any stock which I held on for too long a time. But yes, I think Sun Pharma is one stock which I've been holding for quite some time. That's one of the more longer term holding in my portfolio, and I think this company has done exceptionally well. And other than that, I have some more pharma stocks which I've been, in fact, 3 years ago when we discussed, I said that pharma sector looks good because it gives 20-25% return, which is not very exciting for people who are looking for 50 to 100% return. But compounded, it beats everybody, because when you look for 50% return, there's also negative return which comes with it. And I think, so my largest bet has been pharma sector for last 3-4 years, and that has done well for me. So other than Sun Pharma, I also have stock like Dr. Reddy, Lupin, and maybe a couple of them more.
Before we wrap, I want to revisit cement. You are bullish on cement, but aren't Indian cement stocks expensive? If I ignore the P multiple and only focus on the replacement cost, most of the Indian cement companies are trading at replacement costs which are above the industry average.
Not really. Mid-cap cement stocks are around $60-70 per ton. I think, most of the cement companies today are quoting at a valuation or market cap which is much lower than the replacement. And in terms of replacement, we should also understand that it takes 3 to 4 years. You need to have coal linkages or the captive power. And after, then most of the money is made in the shorter duration, because 2 to 3 years are opportunity. But despite this opportunity, today the valuation is still lower than the replacement cost.
Is it time to go down the ladder when it comes to cement? Ignore Ambuja, ignore ACC, ignore Ultratech, which is now part of the Nifty 50, but look at a Shree Cement, look at India Cements.
Yes, I agree with you, because in fact, what our research has been recommending a stock like JK Lakshmi, JK Cement, and cement like, and I would say that other stocks which you don't cover but should be good are Mangalam Cement, Orissa Cement, Shree Cement. These are Shree Cement also is a good stock. I think we cover that, and so these are the companies that have good management, good understanding of the business, because they've been running cement for a very long time. So I think one should build a portfolio in those stocks.
Construct a bear case scenario and a bull case scenario for me for next 12 months, and then we'll wrap the show.
A bear case scenario is that this government, I would say God forbid, but at least from the economy or stock market point of view, is not able to withstand the pressure of allies and the series of scams or the so-called whatever is coming out, and something goes wrong, and the government is not able to complete the term. That's the worst case scenario. Other than that, other bear case scenario can be globally things go out of control suddenly. If there's some trigger, and say European banks or some systems come under siege and there's a crisis, and during that period what will happen, that foreign capital will have a flight back, because they're all unlikely scenario, but more higher probable events are that the current government and the finance minister, they continue the reform process. The allies or the opposition, they do not have really courage to pull the rug, and so they have to willy-nilly go along with that. And along with that, we are fortunate that the commodity prices stay correct. Despite QE3, the commodity prices have not gone up now. If the crude oil price is correct, then India is really on a strong wicket.
So politics and commodities will dominate and dictate Indian markets for next 6 to 12 months.
And if we are also a bit fortunate in the monsoon, this year will late
You're asking
monsoon.
too much, aren't you?
Yeah, maybe 2-3 things, yes. But these are the two, and the third would be monsoon.
Good to have you on the show.
Thank you so much.
Thank you for joining us.
Thank you.